Hey traders, where we break down smart money concepts with clarity, precision, and real-time examples. If you're serious about mastering trading, you're in the right place. In today's video, we're going deep into the core of live trading with supply and demand and market structure. This isn't just theory, we're going to show you how to think, act, and execute like institutional traders. Here's what we'll cover in detail: identifying clean zones in real time, how to spot high-probability areas where big players enter the market, avoiding weak or broken zones, why some zones fail and how to steer clear of traps, understanding market structure, aligning every trade with the trend and momentum, waiting for confirmations, boss/CHO, no guessing, just data-backed entries. Subscribe channel. No fluff. Just charts, strategy, and structure, so you can trade with more confidence and less noise. Let's get right into it. Step 1. Identifying clean zones in real time. Let's start by laying the foundation of any successful supply and demand strategy: identifying clean, high-probability zones in real time. If you get this part wrong, everything else falls apart. If you get this part right, you build your trades on solid ground. So how do we identify these zones? Magnifying glass tilted left, look for impulsive moves. The institutional signature: a clean zone begins with a strong, impulsive move, a sharp, decisive movement away from a price level. But here's the key: not all impulsive moves are created equal. What you want to see are large candles, ideally full-bodied, not wicky, minimal to no pullbacks, a series of consecutive candles in the same direction, strong displacement, price pushing away with force. These moves represent imbalance in the market, meaning demand outweighed supply, or vice versa, so heavily that price had no choice but to move quickly. This is not retail behavior. Retail traders don't move the market like this. These are the footprints of smart money, institutions, hedge funds, market makers. Brain: why impulse matters. Institutions don't enter with one click. They scale in, gradually, strategically, and often inside areas of accumulation or distribution. But when they're done accumulating, they trigger the move, and that's when you see the explosion. That explosion gives you the evidence you need: this zone had real interest. There was real imbalance here. There were orders stacked here. This is what separates a random candle from a clean zone. Compass: finding the origin of the move. Once you've spotted the impulse, now you trace it back to its origin. Here's how: 1. Zoom out slightly, move up one timeframe if needed, for example, from 5M to 15M or 1H, and observe where the impulsive move began. You're looking for the last candle, or group of candles, before the move. Typically this is a small base, consolidation, or single indecision candle. 2. Mark the zone. Start from the base of the last opposing candle before the move. Use body to wick if the move was clean and sharp. Use wick to wick if the price action was indecisive or volatile. 3. Extend it forward. Draw the zone horizontally, extending to the right. This gives you a clear visual of where you expect price to return and possibly react. High voltage: the 3 types of clean zones. Let's go deeper. Not all zones are the same. There are 3 main categories of valid supply/demand zones based on their structure and behavior. 1. Drop base rally, DBR/rally base drop, RBD. This is the classic setup: price drops, forms a base, and rallies sharply, or vice versa. The base is your zone, very reliable when the base is tight and the move out is strong too. Rally base rally, RBR/drop base drop, DBD. Continuation patterns: price pauses briefly in a tight range before continuing the trend. The base shows reaccumulation or redistribution, often seen mid-trend. Use with structure confirmation. 3. Flip zones: price breaks through a level and then returns to retest it. Former demand becomes supply, or vice versa. Works well when paired with a break of structure. Boss, bar chart, live chart walkthrough. What to highlight: pushpin. Extra filters for zone quality before trusting a zone. Apply these filters. Filter what to look for, why it matters: imbalance, fair value gap, thin volume, fast price movement, sign of urgency, and large orders. Break of structure: did the move break a major high or low? Shows directional bias liquidity sweep? Did the move take out resting stops first? Confirm smart money interest volume spike optional. Was there increased activity, more confluence? If using volume tools, if a zone checks at least 2 to 3 of these boxes, it's probably worth watching. Crossmark common mistakes to avoid. Even experienced traders mess this up. Trading the second touch, first touch equals best odds, second or third equals much lower probability unless backed by fresh confluence. Ignoring structure, a clean zone against the trend is still dangerous. You need alignment. Forcing zones everywhere. Not every pause is a base. Be selective. Quality over quantity. Test tube backtesting. Clean zones. Want to internalize this process? Here's how. Pick a pair, go to the 1H or 4H chart, scroll back a few weeks, find clean impulsive moves, mark the origin zone, play price forward. Did it react? Log the result. Did it touch? Did it break? Did it bounce? Repeat this dozens of times. Patterns will emerge. You'll build trust in the system.
Step 2. Avoiding weak or broken zones. Extended version. 10-12 minutes. In this section, we focus on a critical concept, avoiding weak or broken zones. While clean, fresh zones are the foundation of successful supply and demand trading. Not all zones are reliable, especially if they've been tested multiple times or show signs of weakness. So, how can you tell if a zone is weakened or broken? Crossmark why a zone becomes weak after multiple tests. Let's get one thing straight. Markets evolve. And with this evolution, supply and demand zones evolve too. A zone's strength diminishes with each test, particularly if that zone has already been touched more than once. Derelict house the concept of tested zones. When price touches a zone and reacts, it confirms the zone's validity at that moment. But if price revisits the same zone multiple times, the liquidity that was originally stacked there begins to dry up. At this point, institutions have likely already absorbed all the orders they need. Any additional touches are increasingly less effective. So how do you spot these zones? Stop sign warning signs of weakened zones. Let's break down the key indicators that show a zone has weakened. 1. Repetitive retests. Without major reaction, a strong zone will produce a sharp reaction on the first or second test. If price keeps bouncing, but with less intensity, it indicates the market's diminishing interest at that price level. Key sign. Price reacts less and less with each subsequent touch. Price moves beyond the zone before reversing. When price moves beyond the zone before reversing, that's a red flag. If price pushes through the original demand or supply zone before reversing, even slightly, it suggests that the market is no longer respecting the original level. This could indicate a weak zone. Balance scale why the market tests zones. Before we dive deeper into the concept of zone weakening, let's briefly discuss why the market does this. When a strong impulsive move happens, institutions and big players create liquidity around those zones. But after a while, the supply and demand dynamics shift. Here's why. 1. Absorption of liquidity. When a zone is tested, it's because orders are being absorbed. But after the initial liquidity is absorbed, price may stall or push through the level as fresh orders aren't as abundant. Changing market conditions. Markets don't remain static. As news events, global data, or economic factors influence prices, market conditions change. The context of the original impulsive move could become irrelevant, leading to a shift in market structure and invalidation of the previous zone.
Zone confirmation breakdown. Now, let's go through how to confirm that a zone is still valid and when it's time to let it go. First touch, fresh liquidity. This is the golden opportunity. When a zone is fresh, and price first touches it after a strong move, it has plenty of liquidity. Entry strategy. If you're trading a demand zone, look for a bullish engulfing or a doji candle signaling a potential reversal. These patterns show that fresh buyers are stepping in. Second touch, diminishing power. If price returns to the same zone a second time, you should observe whether the reaction is weaker. A strong move here might still give you an opportunity, but the probability of success is lower. Confirmation strategy. Use additional tools like oscillators or trend lines to validate the reaction. For example, if you're looking at a demand zone, you can watch the Relative Strength Index, RSI, to confirm that the price is in an oversold condition. If the RSI is still low after the second touch, it could be a sign that the zone isn't as strong. Third touch and beyond, broken zones. By the third test, the zone's power is often broken. Institutional orders may have already been absorbed by this point. After the third test, it's likely that new liquidity needs to enter for the zone to hold. Otherwise, the zone could easily be invalidated. At this stage, it's better to move on and look for a fresh zone. Key takeaways: how to avoid weakened zones. 1. Be selective with zone selection. The freshness of a zone is your first priority. The more recently the zone was formed, the higher the chance it still holds liquidity. So, avoid zones that have already been tested multiple times, especially in choppy markets. Look for a strong reaction on the first touch. Watch for a strong and clear price action that shows interest in the zone. If there's no strong reversal or break of structure, boss, move on to the next opportunity. Check for volume and price action confirmation. Volume can be a great confirming indicator. When a zone is about to get tested, check if there's an increase in volume at the zone. If there's no volume, it signals weak participation, and the zone might not hold. Keep an eye on larger time frames. If you're trading a smaller time frame, like the 15M or 30M, always check the larger time frame for confirmation. A zone on the daily chart is much stronger than one on a 5M chart, and this can help prevent you from trading weaker zones on lower time frames. Police car light: avoiding the trap. Emotional trading. Many traders fall into the trap of emotional trading. When the market is moving fast, they see a zone, and they force an entry. Don't fall into this trap. When you spot a weak zone, don't chase it. You'll increase your risk, and that's when your win rate starts to drop. Test 2. Backtesting for weak zones. To avoid weak zones in your live trades, backtest rigorously. Here's a method for backtesting weak zones. Pick a pair and go back a few weeks. Identify the zones you marked as valid, first, second, and third tests. Track how price reacted after each test. Review the third touch zones. Did they fail? If they did, study why. Refine your rules on how many tests a zone can take before it's considered weak. Questions to ask yourself when analyzing zones: is this zone fresh, or has it been tested before? What's the price action showing? Is it weak or strong? Is this zone part of a larger structure? Do I have confirmation from volume or indicators? Am I forcing this trade emotionally, or is the zone still valid? White heavy checkmark. Final thoughts on weakened zones. Avoiding weak zones is critical to keeping your risk low. When you focus on fresh, high-quality zones and avoid those that have been tested repeatedly without solid confirmation, your chances of success go way up. Step 3. Structure is king. In this section, we're diving into one of the most critical concepts in supply and demand trading: structure. Without understanding and respecting market structure, all the zones in the world won't save you. This step is all about ensuring that you're trading in alignment with the market's true direction. Police car light. What is market structure? Market structure is the way in which price moves, and the highs and lows that form within that movement. It's essentially the heartbeat of the market. If you're not respecting the structure, you're essentially betting against the flow of money. Magnifying glass tilted left. How to read market structure. Before we jump into the nitty-gritty, let's break down how to read market structure. In its simplest form, market structure moves in cycles. Uptrend, price makes higher highs, HH, and higher lows, HL. Downtrend, price makes lower highs, LH, and lower lows, LL. Sideways/consolidation, price moves between ranges without making significant higher highs or lower lows. You want to trade with the trend, and that means following structure rather than fighting it. Chart increasing uptrend. What to look for in an uptrend? You'll see higher highs, HH. Each peak is higher than the last one. Higher lows, HL. Each dip is higher than the last one. When you're in an uptrend, look for demand zones to buy. A bullish engulfing candle or a higher low is a great sign of demand. Only consider a supply zone if you see a break of structure, boss, to the downside. Chart decreasing downtrend. What to look for in a downtrend? The structure looks like lower highs, LH each peak is lower than the previous one. Lower lows, LL each dip is lower than the previous one. In this case, focus on supply zones to sell. A bearish engulfing candle or a lower high signals a potential reversal at supply. Only look for demand zones when the market breaks structure to the upside. Why structure is crucial for supply and demand trading? If price is in an uptrend, you want to buy at demand zones and only sell at supply zones when structure breaks. If price is in a downtrend, you want to sell at supply zones and only buy at demand zones when structure breaks. Here's why structure is so important. Smart money follows structure. Institutions and big players understand market structure. If you align with the market structure, you're more likely to find trades that have higher probability. Reduces risk. Trading in alignment with structure minimizes the risk of counter-trend trades. If you try to trade against the trend, you're betting against the dominant force in the market. Increased win rate. When you trade with structure, you'll find that your win rate increases over time because you're entering trades at points of maximum probability. Bar chart. How to combine structure with supply and demand. Now that we know what structure is, how do we combine this with supply and demand zones? Step 1. Identify the current trend. Start by identifying the market's dominant trend. This is your reference point. Is the market making higher highs and higher lows, uptrend? Then, look for demand zones. Is the market making lower highs and lower lows, downtrend? Then, look for supply zones. Step 2. Find the strongest zones. Once you've established the trend, look for fresh supply and demand zones that align with the current structure. In an uptrend, you're looking for a demand zone where price might retrace and find buyers. In a downtrend, you're looking for a supply zone where price might retrace and find sellers. Step 3. Look for a structure break. Market structure breaks are key signals that a new trend or reversal might be forming. In an uptrend, a break of a previous higher low, HL, signals a possible trend change or pullback. In a downtrend, a break of a previous lower high, LH, could signal a reversal or potential retracement. Police car. Light risk of trading against structure. You might be tempted to short a demand zone in an uptrend or buy a supply zone in a downtrend, but this is one of the fastest ways to lose money. Counter-trend trades are inherently riskier, and if you trade these zones without structure alignment, you're increasing your chances of being stopped out. Examples of trading against structure. In an uptrend, if price taps a supply zone and you decide to sell, you're betting that the trend will reverse. This is risky because the market is still moving higher. In a downtrend, if price hits a demand zone and you decide to buy, you're betting that the trend will reverse upward. But with lower lows being made, this is counterproductive. Structure and timing your entries. If you're aligned with market structure, you're more likely to get in at the right time. Here's how. 1. Wait for a break of structure, boss. A break of structure, boss, is a powerful confirmation that the market is transitioning from one state to another. In an uptrend, a boss to the downside means it's time to look for supply zones. In a downtrend, a boss to the upside means it's time to look for demand zones. Patience is key. Don't rush into the market. Waiting for a boss or structure change gives you confidence that you're trading in the right direction. Refine with price action. Look for price action signals such as bullish engulfing or bearish engulfing candles inside the fresh zones. These provide a high conviction entry point. Counterclockwise arrows button. How to backtest structure alignment. To ensure you're trading structure correctly, backtesting is crucial. Here's how you can backtest your trades for structure alignment. Pick a pair and look at a higher time frame, like daily or 4H, to identify the overall structure. Identify the trend. Is it an uptrend, downtrend, or sideways? Mark out the major higher highs and higher lows, or lower highs and lower lows. Track the zones that align with the structure and see how price reacts at them. Pay attention to whether the boss occurs before the trend shifts and whether your zone's aligned with that shift. White heavy checkmark. Key takeaways on structure: always trade with the trend. Uptrend equals demand zones, downtrend equals supply zones. Structure breaks are crucial for timing your entries. Patience pays off. Wait for confirmation before trading. Counter-trend trades are high risk and should be avoided unless there's a clear reversal pattern. Rocket next steps. Now that you've mastered the concept of structure, we're going to move on to the next crucial part of the process: waiting for confirmation before you enter your trades. We'll cover how to spot the perfect setups with break of structure, boss, and change of character, COCH, in the next section. Step 4. Waiting for the break of structure, boss, or COCH. In this section, we'll dive deep into the crucial concept of waiting for confirmation before executing your trades. The break of structure, boss, and change of character, COCH, are the key triggers that tell you when a zone is likely to hold and when price is ready to reverse. Police car light. Why wait for confirmation? It can be tempting to jump into a trade as soon as you spot a fresh supply or demand zone. However, patience is critical. Without confirmation, your trade is based on speculation, and the risk increases significantly. Confirmation is what separates traders who make consistent profits from those who get caught in the noise of the market. Stop sign. What is a break of structure, boss? A break of structure, boss, is the moment when the market breaks a key level, either a higher low, HL, in an uptrend or a lower high, LH, in a downtrend. This break indicates a shift in market dynamics, meaning that a potential trend reversal or continuation is underway. Boss is your confirmation signal to take action. Chart decreasing. Break of structure in downtrend. In a downtrend, price moves in a series of lower highs and lower lows. When the price breaks a lower high, it signals a potential trend reversal. Example: in a downtrend, price makes a lower high, LH, then a strong bullish candle breaks the previous lower high. This boss tells you the downtrend is weakening, and there could be a shift to the upside. Once the boss happens, you can look for a demand zone to buy, confirming the shift in structure. Chart increasing. Break of structure in uptrend. In an uptrend, price moves in a series of higher highs and higher lows. When the price breaks a higher low, it signals that the uptrend could be reversing or facing a strong pullback. Example: in an uptrend, price makes a higher high, HH, and then a sharp bearish candle breaks the previous higher low. This boss suggests that the uptrend is weakening, and a reversal might be on the horizon. Once the boss occurs, you can look for a supply zone to sell, confirming that the trend might be shifting downward. What is change of character, COCH? A change of character, COCH, refers to a shift in the market's behavior that signals a trend change. Unlike the boss, which focuses on breaking specific price levels, higher lows or lower highs, the COCH looks at the overall price action and momentum. A change of character is often seen when price behavior goes from impulsive to corrective, or when price starts making counter-trend moves without respecting the original trend structure. Police car light. Identifying COCH. An uptrend. In an uptrend, a COCH can be spotted when price fails to make higher highs and instead starts forming lower highs. This indicates a loss of bullish momentum. Example: price is making higher highs, but instead of continuing upward, it forms a lower high after a small pullback. This is a red flag. It's a signal that the market could be changing character, and a potential reversal may be coming. Police car light. Identifying COCH in downtrend. In a downtrend, a COCH is identified when price fails to make lower lows and starts forming higher lows. This shows a shift from bearish to bullish momentum. Example: in a downtrend, price makes lower lows, LL, but after a pullback, price starts forming a higher low. This change indicates that the market's character is shifting, and bullish momentum could be gaining strength. White heavy checkmark. Why wait for boss or COCH? Waiting for a boss or COCH gives you the confirmation you need to trade with confidence. Hey race. Why it's so important: reduces risk of false breakouts. The market can often give false breakouts where price moves through a zone only to reverse quickly. By waiting for the boss or COCH, you're ensuring the price actually respects the trend change and isn't just a short-term spike. Ensures trend continuation or reversal. A boss or COCH is a clear signal that the market has shifted. If you enter the market before these events, you might find yourself trading in the middle of a range or consolidation, where price can go either way. A confirmed break gives you clarity on the direction. Higher probability trades. Entering after a boss or COCH increases the probability of your trade being successful. This is because the market has already shown that it's likely to continue in the direction of the break, making your trade more likely to work out. How to use boss and COCH in your trading strategy. Step 1. Wait for market structure break. In an uptrend, wait for the lower high to break to the downside, boss. In a downtrend, wait for the higher low to break to the upside, boss. Alternatively, look for a COCH, where price fails to continue making the expected high or low. Step 2. Confirm with price action signals. Once the boss or COCH is confirmed, look for price action that supports your trade. Some key price action patterns include bullish or bearish engulfing candles, indicating a shift in momentum. Pin bars, showing rejection of a certain price level. Doji candles, indicating indecision and a potential reversal. Step 3. Enter at the optimal zone. After confirmation, enter your trade near a fresh supply or demand zone. Avoid chasing the market, and don't enter too early. Wait for the setup to complete. For example, in an uptrend, after a boss, wait for a pullback to a demand zone and look for price action confirmation, e.g. bullish engulfing. In a downtrend, after a boss, wait for a pullback to a supply zone and look for price action confirmation, e.g. bearish engulfing. Step 4. Manage your trade. Once you enter the trade, manage your stop loss and take profit based on the structure of the market. For trend continuation, place your stop loss just below the previous higher low, for buys, or above the previous lower high, for sells. Set your take profit at key levels where price is likely to reverse or stall. Cross-mark. Avoid the trap of early entries. Entering too early can be one of the biggest mistakes you make as a trader. If you enter before a boss or COCH, you're basically guessing the market's direction. Wait for clear confirmation to avoid getting caught in false moves, fakeouts, or whipsaws. Test tube backtesting. Boss and COCH backtesting is critical for understanding how well boss and COCH work in your strategy. Here's how you can backtest these concepts. Pick a pair and go back in time to identify key zones. Mark breaks of structure and changes in character. Track how price reacts after these breaks. Does it continue in the new direction or revert back? Use this data to refine your entry rules and trade only when you have clear confirmation. White heavy checkmark. Final takeaways on boss and COCH. Always wait for a break of structure, boss, or change of character, COCH, before entering a trade. Confirm with price action. Don't enter unless you see a clear shift in momentum. Trading early increases risk. Be patient and let the market confirm the setup. White heavy checkmark. Final tips for live trading. Always follow your rules, stick to your strategy and wait for the market to confirm your setup. Don't chase the market. Risk management. Make sure to use a stop loss and take profit to manage risk effectively. Never risk more than 1 to 2% of your capital on any single trade. Patience and discipline. Live trading can be emotional, but remember, patience and discipline are the key to consistent profitability. You've now walked through a real live trade scenario and learned how to combine zone identification, structure analysis, confirmation, and execution into a single, cohesive strategy. This is how smart money trades, and by following these principles, you'll be able to trade with confidence and reduce the emotional stress that comes with guessing the market's direction. Stay tuned. Subscribe channel now, for the final summary in the next video, where we'll wrap up everything you've learned and give you actionable steps to improve your trading.